Hello, everyone. My name is Peter Mitchell, managing partner of Kingsgate Capital Partners. And with me today is Andrew Johnston, one of our long-serving advisory board members of Kingsgate Capital Partners, as well as Craig Mercer, Chief Research and Sustainability Officer at Dalton Investment Partners. Andrew and Craig, before I hand it over to you, let me just give you a little bit of background in terms of our relationship, the Kingsgate Capital Partners relationship with Dalton Investment Partners. Several years ago, approximately 3 years ago, we wanted to find an Asian equity specialist. And as we met different people across the globe, we were immediately drawn to Dalton Investment Partners. They have 6 investment offices around the globe. They've been in the Asian region managing equities as well as in the earlier days, some of the fixed income securities. But they have been there for around 30 plus years, up and down the Asian region. And in particular, what we thought was also attractive was their Indian equity capability. And it certainly didn't hurt that Craig Mercer, while he was supposed to be traveling all over the place, in addition to COVID hitting, he was, fortunately for us, based in Sydney, Australia. So we're pretty happy to take advantage of that presence. But at the end of the day, what we were really happy with and impressed was their breadth of capabilities. $5 billion from across the globe by some of the world's largest and most sophisticated investors, ranging from pension funds, endowments and foundations, as well as family offices. In fact, some of the early clients of theirs remain with them to this day. So without further ado, maybe let's get stuck into it. Andrew and Craig, I'll hand it over to you, and good luck.
Thanks, Pete, and thanks, Craig, and welcome back to Fire by the Fire, and thank you for making the time to share your insights with us. I want to start today by asking you, knowing that the focus that you have across unique markets in Asia, how does the Dalton Investment Partners approach differ if you look at the market dynamics between India and Japan as a great example, different economic environments, different political factors, and different growth drivers? How does your approach differ between those two markets?
At the end of the day, thanks very much again for everyone for having me. It's a pleasure. And I just will clarify, it's Dalton Investments Incorporated, not Dalton Investment Partners. Just so people Google us one day, that it's they find the right company, because there are a few Daltons out there. Look, at the end of the day, we've always been what's best described as a value-focused investor. So what we mean by that is we're always trying to find investment securities where the value that's available is sufficiently different from the price. That's something that Warren Buffett would always have sort of historically talked about, the difference between value and price. So ultimately, when we are thinking about, say, obviously the very different environments of economic sort of growth in both India and Japan, but ultimately the process is very much the same, in that we're trying to identify companies that have I guess a material discount to what the intrinsic value is. So, trying to buy dollars at 50 cents. Now, clearly in a market like India, growth is much more substantive. They've got very different demographic structures, vastly different population dynamics, et cetera. They're in very different parts of their economic development cycle. But ultimately, it's the same thing. If we can find securities that are trading at discounts to what we think is the intrinsic value of that business, we're very interested in that. And of course, that looks very different in terms of type of company, whether it be in Japan or in India.
Does that mean that you end up with very different specific factors and industries that you're focusing on, given those differences in growth drivers and demographics?
Yeah, I mean, look, at the end of the day, everything typically is very much driven from the bottom up. So we don't really set out at the outset to go, we like specific industries or sectors. It's really driven by where we're finding value. What's quite fascinating at the moment is we actually have, to some extent, some quite similar exposures in whether it be Japan and India, and for very different reasons. And it would seem slightly counterintuitive at the outset when I'd say we're quite focused in Japan on what we'd call consumer brand companies. So companies that in the food product sector, and similarly, we have the same kinds of exposures in India. Now, one might assume that, obviously with a growing consumer class in India, that would be a more logical place to be thinking about investing. So why do we hold those kinds of investments in Japan? And that really comes down to the first point that I made. It's about the difference between what we think is fair value and price. In Japan, you have some world-class brands that we think are deeply undervalued when you look at them in the context of international peers. For example, I'll give you, a couple of simple examples. So Yakult, which is a very well-known global brand within the probiotic drink space, or Izaki Glico, which is famous for making chocolate pretzel products. These are companies that have really big brand cachet, but they're deeply undervalued, and have, very poor historic capital allocation practices, which is one of the reasons why they're trading at such significant discounts. On the other side of the coin, in India, you might have companies that are just simply growing at a very, very fast pace because of the growth in I guess, the middle class and the consumer. So companies that, for example, the primary bottling company for PepsiCo International in India, that would be a classic example of a really good success story there, which is just literally compounding growth as a consequence of the growing market.
Okay. Given those differences in the growth dynamics, does that then, and I'm guessing underlying volatility within those markets, does that then inform your position sizing and risk parameters, or do you have a risk matrix that's based on volatility or movement?
The short answer to that is no. A lot of the time, I mean, if you look across all of the portfolios that we run across Asia, where there are regional mandates, of course, we run some dedicated country strategies as well. But in the context of regional mandates, it's probably fair to say that every account in our business will be overexposed to primarily three economies at this point within the Asian region. First being India, second being Japan, third being Korea. Vastly different reasons for being overweight in each of those individual economies, but that's being really driven by the bottom up and what we're seeing from the ground from the bottom up in terms of the opportunity set. Now, the individual constraints around how we structure the risk in those mandates is really driven at the end of the day by the client. Where we're completely unconstrained, we'd be overweight those three markets, and that would really come down to what don't you own is probably more of an interesting question. And at the moment, it's probably fair to say we have almost zero exposure to China for a variety of reasons that, not just macroeconomic issues, but that issue around trying to find companies where there is a significant difference between value and price, where those companies would meet the sort of criteria that we look for in investing, which is, really what we'd call our four mantras. So buying good businesses at a discount where there's a management with a track record and the management is aligned to the success of the equity. So through equity ownership. And in China, that's a much rarer thing to find. So really in those markets, it's really driven by the bottom up. And then at the overall portfolio level, really comes down to, how much exposure we have to specific industries or specific thematic drivers, and whether or not we have too much or too little exposure to things that we think have long-term structural tailwinds.
Speaking of long-term structural tailwinds, I think you were one of the first that was really talking heavily about some of the changes that were happening in Japan. And certainly to our investors and listeners, that was something that we were talking about many years ago. Now, yeah. Is that tailwind still there? Is that still informing your allocations in the same way, or is it starting to progress and evolve? And should investors be aware of changing dynamics in Japan?
Yeah, I mean, it's a great question, and it's one that given the strong performance of the Japanese market, say over the last 3 years in particular. It's a very pertinent question. I guess to use a baseball analogy, given that we're a US-based firm, in a 9-innings game, of a baseball match, we're probably only in the third or fourth inning, in that there's still huge valuation discrepancies and huge swathes of companies that are being poorly governed or have very poor capital allocation processes, are deeply undervalued as a consequence of hoarding assets on balance sheet and not deploying those in an effective manner. So to answer the question about has that changed the way we're sort of allocating capital, if anything, it's actually we've been increasing exposure into the Japanese opportunity set across most of our mandates, and it's ultimately a large proportion of our growth as a firm has come in that asset class, because the opportunity set is more abundant than we have capital. So it definitely is keeping us very focused, but also, quite honestly, we're having an enormous amount of success in actually seeing companies transition themselves, whether it be through significant capital allocation programs, things like share buybacks or returning capital to shareholders in other forms, or divesting underperforming assets, but also doing things like management buyouts. We've seen a large number of management buyouts, disproportionately so within the companies that we're investing in, which is another way of them basically returning capital to shareholders. That a lot of these companies shouldn't be publicly listed, and they know that.
Okay. You mentioned Korea before. A lot of my questions are focused on India and Japan.
Yep.
Is there anything you want to tell us just quickly about, the dynamics there that you see as attractive? Obviously, most of us would know some of the very large names there, but where are you seeing? What is it about that market that is so attractive, and where are the opportunity outside of those, top one or two names?
So going back a few years, when I say a few years, probably 3 decades. So Jamie Rosenwald, the CIO and sort of co-founder of Dalton Investments, prior to setting up Dalton, he made a pitch to a very famous investor called George Soros about the interest in Korean equities at that time. So it's roughly 3 decades ago. And he described that as what he called, and using another baseball analogy, a fat pitch. And he's of the view that we're in this period now where he's been presented with the second fat pitch of his investment career. And that's because Korea is probably the most deeply unloved market in the world. And if you look at what happened in Japan over the past decade with corporate governance reforms, that's led to a massive unlocking of value. And Korea is effectively very similar in terms of its inefficiencies, the purported, Korean discount that stems from that poor corporate governance and poor capital allocation. We think we're just at the very beginnings of that process, sort of starting to unlock value, which is why we launched a dedicated Korean strategy mid last year, probably at the very early phases of that product becoming something more meaningful. But that being said, I think of being invested now is where the real money will be made.
Well, I think those kind of dedicated strategies is something that a lot of Australian investors just don't get to see. So it's probably not something that's ever been on their radar, but probably something that should be. So, well, thank you, Craig, for those great insights into your strategy and your team. It's very clear that your expertise in Asian markets, is on the ground, and it's been there for a long period of time. I think it's unparalleled and very unique as an offering in the Australian market and in what we get to see. For our listeners, if you want to hear more about Dalton and any of its strategies, please get in contact with the Kingsgate Capital Partners team or head to the website. Thank you to everyone for listening to Five by the Fire.
Thank you very much for having me.